Okay, welcome to Chapter 6, which is on interest rates and bond valuation. Okay, we're going to start off with some basic definitions about interest rates, and we're going to move on to bonds. It's a little bit of a hard chapter, so make sure you've read it and you take a deep breath. You might want to watch things twice just till you get your handle on it. Alright, first of all, let's start with some basic terms. Interest rate. When we think of interest rate, we usually think about what we have to pay on a loan, or the amount of money somebody's asking us to pay because we have credit card debt or whatever it is. Interest rate usually refers to compensation from using somebody else's money. Required return is usually what we apply to stock investments. So I say, okay, if you want me to put money into your stock, I expect to make X amount of money rather than just keep it in my mattress. So both talking about rates, one in terms of a charge paid to use somebody else's money, and one in terms of an expectation or what we'd like to make on that investment in order to get us to agree to invest. Alright, what determines interest rates? Okay, the three biggies on what makes a rate what it is. Inflation. Okay, inflation, as we all know, is the rise in cost of things over time. So if you talk to your parents or grandparents about what things were priced at in their childhood, you laugh about it. My dad loves to tell me the stories about how he used to make 25 cents an hour picking broccoli on a farm when he was a little kid. And he wasn't laughing at the time. He needed that money. That wasn't a ridiculously small sum of money now. Then it seems that way now because over time the value of money has changed. So all else being equal, if we loan somebody $1,000 and they take 10 years to pay us back, we've lost money because the $1,000 we get back isn't going to be worth what it would have been. Okay, that's what inflation does. It eats up the earning potential of our money. The other determinant of interest rates is risk. The riskier the investment, the more I'm going to demand. So if you want me to take my money out of my nice, safe, FDIC insured bank account and put it into your new startup company, I'm not going to do that for the 2% I'm getting at the bank. I'm going to want to make a lot more money in order to compensate me for the additional risk I'm taking on. The key determinant of interest rates is liquidity preference, which that says, all else being equal, I would rather get my money back sooner or later. So if you're asking me to wait longer to get my money, I'm going to charge you more in interest. If you're going to pay me back sooner, then the interest rate might be lower. Okay, so those are the three basic things that interplay to come up with what interest rates are at. Our other definition here is nominal versus real rates. The nominal rate of interest is what's stated or what's written on the paperwork, okay? What the supplier of funds is charging and what the user of the funds is paying. That can differ from the real rate of interest based on inflation and risk. So what is there being charged may change based on the value that money turns out to be worth. So in other words, inflation. So I used to be happy with 9%, but now inflation's so high that 9% doesn't look good anymore. Okay? And of course the risk premium. The fact of the matter is some people don't pay me back. There's risk to my money that impacts how I feel about my interest rates. We have another definition called the term structure of interest rates, and if you'd like you can look this up in the Wall Street Journal, online or in the paper. It's published all the time, these things called the yield curves. And the yield curves graphically show you the relationship between maturity and rate of return for bonds. So let's look at it. This is what typical yield curves look like. So off on our x-axis is the time to maturity in years, and our y-axis is the rate that we have to pay or what we're earning, depending which side of the equation we're on. So you can see a couple different yield curves depicted here. In May of 2010, you'll see one where the lower the time to maturity, so the shorter period of a loan, the lower the interest rate, and as we increase, the longer. So in other words, in this scenario, a 10-year mortgage would have a lower interest rate than a 30-year mortgage. That's pretty typical of what we see. We call that the normal curve. What else happens in our economy sometimes is a flat yield curve, like here in 1989, where the rate really didn't change much depending on the maturity. Then we have a time in 1981 where the rate was actually inverted. So it was actually cheaper to get a long-term loan than a short-term loan. Okay, those situations all occur. The one here in gold in 2010 is more typical of what we see, but at any period in our economy, all three may happen. So again, that normal one is the upward sloping, which means usually it takes you more money, higher interest rate on a 30-year mortgage than a 10. Inverted says the opposite, where short-term rates are actually higher than long-term rates. That usually happens because we anticipate rate reductions in the future. And then a flat yield curve says it just doesn't really matter much. The rate's going to be about the same no matter what. All right, so let's talk about how bonds fit into the world of interest rates that we're discussing. All right, first definition. A bond means you loaned money to the company. So you're not a stockholder, you're a bondholder, which means the company borrowed money from you. They have to pay you back what they borrowed, and they have to pay you interest. You are a creditor of that company. The bond agrees to pay you some coupon rate. Coupon rate is the stated rate, the obligation between you and the company, what they have to pay you. Most typically for bonds, they pay it twice a year, so semi-annual payments. Sometimes annually, but most typically twice a year. The face value or the par value of the bond is the amount that they have to pay you back at maturity. That is assumed to be $1,000 unless told otherwise. $1,000 is the most common denomination for bonds. The maturity date is when they have to pay you the principal back. So a 10-year bond means, yeah, they have to pay you interest between now and year 10, and then in year 10 they have to give you the principal back. Some bonds are what we call convertible, which means that the bondholder can turn them into stock. Why would they want to do that? Well, because the value that they can convert them at is set when they get the bond, and the stock may have been doing really, really well, which means all of a sudden there's more upside potential for them to get rid of their bond obligation and move into stock. From the company standpoint, they get rid of the debt obligation, which is nice. They gain another equity holder. Current equity holders obviously might have a little bit of issue with that because it's going to dilute their earnings, so companies are required to disclose all the possible conversions that are out there on their annual statements. Some bonds, in fact most, have what we call a call feature, which means at the company's discretion they can choose to pay you back early. Okay? When they pay you back early, they typically have to pay a little bit of premium to do that, but they get rid of their obligation. Now why would they want to pay you back early? Typically because rates have fallen. Okay? So you, the holder of the bond, usually aren't thrilled to have it called, because that means your bond is paying you more than the going rate in the market. They're going to retire your bond, and when you go to reinvest that money, you're going to get something much lower. So you typically don't like that. All right, bonds are rated, just like us as individuals are given a credit score. Bonds, the companies that stand behind them, are rated. And Moody's and Standard & Poor's are the two big rating agencies. Their rating scales, you can see, are pretty similar. A's being the best. The further down you go in the alphabet, the worse they are. Depending on what the investment is, like certain pension funds and work funds that you have will only be allowed to invest in what we call investment grade or high level funds. The further we go down, so the lower the score, the more they have to pay in interest. Just like you, if your credit score isn't good, your credit score that you get from TransUnion, Equifax, and Experian, if your credit score is low, you're going to pay a higher interest rate on your mortgage, on your auto loan, if you can get it at all. Same thing for a company. If they're not rated well, they will pay a higher interest rate because they are being assessed as being riskier, or the likelihood that they're not going to pay you back is higher, so you're going to demand a higher interest rate. So having your rating changed by these agencies is a big deal. It can cost you tons of money, or if you're improved, it can save you a ton of money. So what we're going to do when we come up with our value of bonds, we're going to look at the process of valuation, and that says we can come up with the value of what an asset is worth based on the cash flows that it's going to produce for us. So we have cash flows are part of our factor, timing, or when do we get the money, and then what is the risk involved that we may never see that money or that some other problem might happen. So we can value anything if we know those three key inputs. This is what it looks like when we value a bond, and we're going to look to do this in Excel again. We're going to move beyond what we did in Chapter 5, and we're going to go a little bit further. We're using the same function, the present value function, and now we need to come up with the value of a bond. The key difference is that bonds have both an annuity component, which is the interest, and they have a fixed value component, which is the principal they get back in maturity. So let me show you for a second here what this looks like in the way we've been doing it in Excel. Okay, this is your same present value function that you've used in Chapter 5. When we come up with the value of a bond, we're looking for the price of a bond. You can see there's a few little hints down here for you. This slide, by the way, is in your time value of money screenshot slides, those ones from last week, so you may want to pull this out again. This is the slide that you want to look at on bonds. When we come up here in rate, we put in the going market rate, or the yield to maturity, or the required rate of return. Point is, we enter into this rate box anything other than the coupon rate. The coupon rate never goes into the rate box. The coupon rate is only used down here to determine the payment. So the rate is the amount we're going to discount by, and that is what's going on in the marketplace. So in your problems, it will be yield, yield to maturity, going rate in the market, the rate similar bonds are paying, anything other than the coupon rate. Okay? And here, for number of periods, we put how many periods until maturity. This could be years, or it could be semi-annual. If it's semi-annual, I'm going to have to take that rate and divide by 2, take those periods and multiply by 2, just like I had to do with the monthly stuff last chapter. Now in here, my payment is going to be how much interest do I get each period. So in this case, my coupon rate was 14%, and my par value was 1,000. So I put that in here, 14% times 1,000, you can see 140 is my interest payment. My future value is going to be the par value I get back at maturity. So again, usually 1,000, unless the problem tells you something different. And you can see here in this case, Excel is telling us that this bond should be priced at, or we should consider it worth, $1149.39. Okay, so it's a premium bond. And I want to go back to that for 1 second. If you look at the relationship between the interest rate in the marketplace and the coupon rate on the bond, it can tell you approximately how your bond should be trading. So in other words, and to back up a step, remember that when we trade bonds, they're already issued out there. Okay? If you were to go to a company that's issuing bonds on day 1, and you were to give them your $1,000, and they said, we're going to pay you 10%, and you held that bond until maturity, you'd make 10%. You'd collect your 10%, you'd get your $1,000 back, everything would be fine. The reason we have to do bond valuation is because bonds are bought and sold on the secondary market. So we're constantly trying to calculate a price for them. The reason the price changes is because what's going on with interest rates in today's market is changing. So let's take this bond as an example. We have a bond that has a coupon rate of 10%. The market is now at 12%. So I can get something else for 12%. So why on earth would I buy this bond? Well, I would buy this bond if you sold it to me at a discount. So I pay $887 for this bond. I collect $1,000 in 10 years, and I collect $100 in interest each year for 10 years. So when all is said and done, I will make my 12%, the difference between what I paid for it and the value I get in the future, plus my interest rate. In this scenario, we have a bond where the coupon rate is 10% and the market is only demanding 8%. So our bond looks really attractive, and people are going to bid up that price. And in fact, that price will be approximately $1134.20, which means I pay $1134 for something I'll only get $1,000 back for in 10 years. But during those 10 years, I'll get a premium, 10% interest compared to the market of 8%. So when people tell you that you can't lose money on bonds, that's not entirely true. Bonds are a very safe investment. But if I buy it at $1134 and then interest rates in the marketplace change, that bond could be worth less in a couple of years when I go to sell it, and I could lose money on the bond. Now, the reason why they say bonds are such a safe investment is because interest rates don't fluctuate at near the level that stocks do. So in general, the swings are much smaller. But you do still have to have some caution in the type of bonds you invest in and the terms that you invest in. You can make bad decisions. In general, if you get a nice diversified bond fund, you'll be just fine. You'll make a small interest rate, and you'll be happy, and your money will be safe. But you do have to be careful. It's not guaranteed. Okay. So again, this is the way it's going to look in Excel. Here's the hints down here to help you out about dividing by 2 of semi-annual, multiplying by 2 of semi-annual. So all of your things have to be in the same sync. They all have to match. Okay, and lastly, we're going to talk about the interest rate risk a little bit more. I knew my phone had stopped ringing here. Interest rate is the chance that interest rates will change. So what we have to know, what's most important to know about bonds, is that they work inversely with interest rates. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. Bonds are intimately connected with interest rate that affects them quite a bit. The yield to maturity is the rate that we're going to earn if we hold this particular bond based on what we paid for it until maturity. We can solve for the yield to maturity by using the rate function in Excel that we used back in Chapter 5. So the yield to maturity, again, is going to be how much, if you hold it based on the price that you paid for it, how much you'll make. Okay, so we can look at that again here using the rate function. Key thing here is to remember we're going to assume that we pay money for this bond, so that present value has to be negative, and then we're going to put the cash flows that we're going to get, the interest and the future value, as positive. So remembering your negative and positive signs will be absolutely critical. Okay, so hopefully that gives you a little bit of a better idea about what's going on with bonds and interest rates. Please do remember that it's a chapter that has to absorb in your head for a little bit, and feel free to let me know if you have any questions, and I'll be glad to help you out some more.